Hi there and welcome to a brand new edition of Who Moved the Market. I'm Surabhi Upadhyay and with me back on the show is Reema Tendulkar. Now Reema has had a very busy, last 24 hours because she's been going through all of these big numbers. TCS reported yesterday after market hours, so did HCL Tech. And guess what? Remember we were telling you that it's going to be a very subdued quarter for IT companies. That's exactly what was delivered. But Reema, the stocks are still running high. In fact, IT has been the leading sector in the market today. What's going on?
Well, I think the street was expecting far worse, right? There are no nasty surprises in the numbers. It's undoubtedly weak, right? You've got an HCL Tech declining for the second consecutive quarter. TCS hasn't grown. Growth rate on a year-on-year basis is down to single digits, something we've not seen in the last 2 years. So no doubt this is exactly the subdued quarter that the street was talking about. But I think there was a segment in the market which was fearing far worse, right? Because we've had a slew of downgrades over the last couple of, maybe a last month or something, saying that the current estimates on the street are way too high. They will need to be downgraded. We are going to see some very sharp EPS downgrade. And also, I think secondly, there has been some positioning. Like for instance, HCL Tech had already fallen in anticipation of weak numbers. So it's been, sell the rumor and, buy the fact, the reverse. The reverse taking place this time on HCL Tech. And for TCS, it was pretty much an okay inline quarter, bad, but well, we told you so, right? They told us so in Q4 and we told you 2 days back.
I guess it also has to do with the market's mood. I mean, it's not like as if these stocks have collapsed and the Nifty is up 7-8% this year and IT, these stocks are down 10-15%. Actually, no, TCS for the year as a whole, through the volatility, remember the first quarter, Jan, Feb, March, these stocks were flying away along with the Nasdaq, and then came the reality check in April with Infosys's numbers, and then the decline started. All things put together, TCS is still up 2-3% for the year as a whole.
And another very important thing is that after yesterday's US CPI inflation print, the number of rate hikes, right, in the US perhaps is now going to be 1 rather than 2. The street was still divided between 1 and 2. So in a way, we are truly approaching the end of the Fed rate hike cycle, and that is positive for the valuations of the IT companies. In a way, they protect the downside for the IT valuations, and that in itself is a very big technical trigger. It's not technical trigger, but I think it's a very big trigger to play on the sentiment.
No, it's a technical sentiment trigger. It's also a macro trigger, because if the market starts believing that okay, the US is done hiking interest rates.
No, I mean not a fundamental trigger, but this is something which had led to the PE rating in the stocks, the higher cost of capital, the higher interest rates in the US and how they were benchmarked. I'm saying once that comes to an end, you're putting a floor to the valuation.
Perhaps, and that's why there's a lot of buy on dips that's played out. Today's entire thesis on IT stocks has been a buy on dip. Okay, let's get down to some all the gloom and doom talk. So you tell us what are the most important numbers we should look at for TCS?
Well, the most important numbers always is the top line, where there is no growth, 0% quarter on quarter, 7% year on year. The second number to track will be the margins, and margins this time are at 23.2%. It's a decline of 130 basis points quarter on quarter. TCV, that's the total contract value, which basically means order wins. It includes old renewals and new deals. So that has grown, that has increased by $10 billion. So increase is not the right word, but TCV stands, the order win stand at $10 billion plus for the second consecutive quarter. Now this is higher than the company's quarterly guidance van. They've always said we'll lose between $7 and $9 billion, but for the last 2 quarters, they've done more than that. 10.2 this time, 10 last time. What this is basically telling you is that even though discretionary spend is coming down, there are enterprises who are betting on the long-term tech spend. So these are long projects, right? The Nest deal that they won. It was a very large deal. It was a UK-based deal for I think $1.9 billion. So that constituted a bulk of it. That's over 10 years. So companies are still willing to invest big money over the longer term. They're just unwilling maybe to start start converting it into revenues right away.
Okay.
I think so. These short term, there is uncertainty, but I think over the long term, given the kind of deal wins we've seen, I think the tech spending is still very much intact, and company has been winning in the cost optimization deal and vendor consolidation. By vendor consolidation, we mean that if a client has if an enterprise, that's a company, has 2 or 3 technology service providers, they say, you know what, we don't want to deal with 2, 3 of them, we want to deal with one person. So we need one person who can do everyone's job. So you typically will need a large player who has an array of services, a full suite service provider, and TCS fits right there. So it's been benefiting along with the rest of the IT companies in vendor consolidation.
Okay, got that. Now Reema, you also managed to meet the new man, K. Krithivasan. What's the vibe that you picked up? What's the sense that you got of him? Because he's obviously come in at a very interesting time, challenging time, a lot of changes, AI, so on and so forth. So what was your takeaway?
You know, I think he's a very straightforward person.
Okay.
Right? He said it as he saw it. He's not trying to please the crowd. He's sugarcoat it.
Okay.
He didn't use too many jargons. So, you know, you
big words which leave you confused about what are they really saying.
I think, but you know, the thing is, the truth is probably that even he doesn't know when clients will start spending on discretionary projects. Long term, he's seeing spending, right? Because you're winning deals. But just in the near term, whether companies are willing to do that discretionary spend, which they've put on hold, he doesn't have that clarity, and he said it. Right? I can't call out a second half recovery because this quarter we have not had growth and we're not seeing it as of now. When it does, we'll tell you about it. So pretty straight face, saying it as it is, honest, transparent, upfront. So limited interaction just over the press conference and you know, today's interview.
Anything? Sorry, I didn't ask you about the employee situation, because one thing that we've noticed for I think both of the companies is that attrition levels have come down significantly from the peak of the Great Resignation. I think the reality is very different in the IT sector. So anything else from maybe a margin perspective, employees? Some of the other nuances maybe you picked up from the HR.
Remember there was moonlighting also. So I think so don't forget, not just Great Resignation, we had moonlighting, and now we're in a situation where you know, tech employees are not very happy. At least TCS has doled out its increments on 1st of April as they normally do, right? But Infy has deferred its wage hike. TCS, HCL Tech today has said that we're skipping the hike for senior employees. For the mid to junior, they're going to defer the hikes by 1 quarter. So the tide really turned, right? We were envying the tech,
all through the COVID period,
through the COVID period, and now, unfortunately, it's a bit of like equalization, normalization taking place there. But attrition is coming down, right? So I think very comfortable. Both the companies indicated that attrition should be on the way down. They said it should get back to what it used to be, the industry-leading kind of levels in a couple of quarters, so that's fine. On hiring, given the moderation that we've seen in growth and the fact that companies have hired a lot during the COVID period in anticipation of that strong growth, hiring is literally at a standstill.
There's no hiring happening.
As in, what is happening is they're honoring the offers that they've made to freshers. But if you quit tomorrow, they're not replacing
because they have enough bench strength
they have enough
to take care of
it,
it.
right? And growth is not there. At least as of now, it's not that projects are there and there's no one to fulfill it. It's called backfill attrition.
Okay.
Backfill attrition, right? When a person quits, you're not looking to, that's attrition. When a person quits, you're not looking to fill it up. So
you backfill the positions. Okay, so good insights, great insights, and actually for the sake of the economy as well, we hope IT picks up because it's a large employer and it has a huge wealth effect. I mean, real estate, a lot of other allied services. Generally, when the IT guys and techies do well, the economy does well. But anyway, let's come down to the specifics for HCL Tech, because frankly, when I saw the numbers yesterday in the evening, I thought, oh Lord, I mean, there was a miss on the top line. Reema was telling us that the company will have at least 0.5% growth at the top line. They actually have seen a fall in revenue. I think 1.3% fall in revenue. And my God, a huge margin miss.
A huge margin miss. I was actually cross-questioning when I saw margins down by more than 100 basis points. I said, wait, was there a wage hike? Did I miss it? Maybe they doled out a wage hike and I didn't catch it, right? Did I miss it in my estimates? And I was going back and trying to rack my brains while I was speaking and analyzing those numbers. Then what if I missed it?
So over 100 basis points drop in margins, that was not anticipated.
And without a reason, right? I mean, the only reason is that there was no growth. right? When your revenues come down, your costs remain the same, so your margins fall.
Yeah.
But you typically don't see, a drop in margins to this extent in a non-wage high quarter for IT companies. But HCL Tech is undoubtedly a top-down miss, minus 1.3% revenue contraction. Revenues contracting for the second consecutive quarter. Margins have fallen again by I think 130 odd basis points, quarter on quarter to 17%, much lower than what the street was anticipating. Deal wins have come down by 25% on a quarter-on-quarter basis. For the last 7 quarters, their deal wins were above $2 billion or above. This time it's come down to $1.5, $1.6 billion. The net headcount has fallen by 2,500 employees, again signaling that things are slowing down and they don't want to add too many employees to their bench. So it was an overall weak quarter, but the strength in the stock is quite something today.
You know what I'm doing is I'm just checking the performance for this year. The Nifty is up 7.4%. HCL Tech is up 7%. So, in between, sure, there has been the stock, rose very sharply and then also fell very sharply just before we got into the numbers. But again, I mean, the market positioning and the way the market's receiving these numbers, frankly, I'm a little surprised. Because of the strength which has been exhibited, including today. So let's come down to what the management is saying, because clearly the street is willing to see through this phase, saying maybe they'll pick up. But is the management also sounding as confident?
Yes. After this big miss in Q1, everyone would have anticipated that the full year guidance numbers are going to be that much tougher for you to achieve. But the company is holding on to its FY24 guidance. 6 to 8% on the top line, margins of 18 to 19%. And remember, in Q1, margins are at 17%. So it's quite a task for them, climb for them to get back to those guidance. So guidance is intact. I specifically asked him, I said, in the current quarter, tech and telecom has been weak for you. Does it recover? When does it recover? He said it recovers in Q2.
Oh, immediately, like in the next 3 months?
He's looking at a quarter-on-quarter growth. I asked him, what kind of year-on-year growth are you looking at? He said, I don't want to get into that. Our focus is on a sequential improvement. So he is penciling in a pickup, kind of indicating that the weakness that we've seen,
probably a one-off or some specific clients.
But I think there is going to be a sequential pickup, right? So that's something the street is taking hope from, some confidence on HCL Tech in particular, that the worst of the ER&D spending cuts could be behind the company. Because the company has held on to its guidance, and the company commentary also seems to suggest that in the conference call yesterday and in today's chat.
Okay, so there you have it, TCS and HCL Tech. Finally, as we wrap, Reema, any interesting street view or brokerage call that stood out? I mean, JPM we know is a perennial bear, and I think they've cut their target price on TCS even lower. But at any other note or any other sort of brokerage commentary that
it's quite divided. You have JPM, I think, at 26.50, and then you've got a Bernstein on TCS at 36.50.
Wow.
So it's literally...
It's a real bull versus bear.
It's a real... On HCL Tech, you've got someone at 900 and you've got someone at 1500, and the stock is right in the middle there at 1100.
That explains why there's buying on tips, because you have the bulls who believe that this is a great time to accumulate.
And for HCL Tech, valuations are also fairly attractive, right? I mean, compared to where Infi TCS are, it's always had that valuation comfort. If they can get through this weak quarter and things really improve, then maybe it would have turned out to be a good buying opportunity. But again, that's not a call that we would make.
Absolutely. But what we have done is presented all the facts in front of you, threadbare.
And there's one more, the acquisition. HCL Tech.
Oh yes, they did a small acquisition of an automotive software company. Glad you mentioned that. So what is this all about? Just quickly tell us.
It's a German automotive engineering company called ASAP. They will be spending $251 million. The acquired company has revenues of about $154 million. So the valuation is attractive. It's not too expensive. I think it's done at an EV of 1.5, approximately 1.5 times EV to sales. So valuation is fine. The reason the company has done this is they're saying that the automotive engineering segment is seeing very high spend. So they're not seeing cuts. It's been the fastest growing segment, which explains KPIT's strong growth
meteoric rise on that
and even
stock.
growth numbers, right? Growth numbers for KPIT have been very strong. So they said they were not present here. So they felt they needed to up their presence in this segment in auto engineering, which is where KPIT Tech resides. So they've gone ahead and made the acquisition.
They've kind of done that little tuck-in acquisition to fill that gap. Perhaps that they felt is there in the portfolio.
And they clarified that the guidance is X of this acquisition. So they're not doing this acquisition to boost their revenue growth for this year at least.
Got that. Important takeaway there. So there you have all the details that you want to know possibly on TCS and HCL Tech. Hopefully this has been helpful, but remember the season's just started. We are going to watch out for Infosys, that's the big one.
Wipro today.
There's Wipro today, so there'll be plenty of tech talk on who moved the market, and Reema is going to keep us up to speed with all that is happening. For now, it's a wrap from the team and from the two of us. Thank you very much for tuning in. Have a great afternoon, evening, and we'll see you again with another theme tomorrow.